Amortization and income tax. What is CRA? CRA stands for Canada Revenue Agency. The CRA is a federal agency that regulates tax laws in Canada. They administer tax laws for the Government of Canada. How does it relate to amortization? They allow taxpayers to deduct amortization expense when calculating taxable income. The CRA has specific rates for different assets that are allowed to be used when calculating amortization. The CRA rates are used for all types of amortization, also known as classes. This ensures companies are using proper depreciation rates. What method does CRA require a company to use and why? The CRA requires a company to use the single declining balance method. Companies are prohibited from making up their own amortization rates and useful life for any CRA class assets. The CRA does this so they can group assets into various classes and provide maximum amortization rates for each class of capital assets. This keeps companies from modifying their own incomes in order to be taxed less, and also prevents companies from increasing depreciation rates on any given asset. What is CCA? CCA stands for Capital Cost Allowance. The CCA is the tax deduction for depreciable properties such as furniture, equipment, computers, or even buildings that wear out over time. Capital cost asset means that when you buy depreciable property, you can't just claim the entire cost of the property as an expense. You must deduct the cost of the depreciable property gradually over periods of years. There's a total of 20 CCA classes and having different amortization rates. An example of a CCA class would be Class 10, which motor vehicles fall under, with a depreciation rate of 30.